Hey everybody, welcome to March. And the bond market doesn't like March much better than it liked February. Started out the month being down 15 basis points on the open. The 10-year was up 5 basis points. Federal Reserve Chair Jerome Powell and his colleagues confront a legitimate head scratcher as they probe how high to raise interest rates in the coming months. Why is wage rates slowing if the job market is so tight? A couple of head scratchers right there. The answer will go a long way to determining whether the Fed will bring inflation down without doing much damage to employment and the economy. If pressure on pay keeps easing, even as employers keep hiring, policymakers may feel less compelled to push rates even deeper into restrictive territory in their drive to return inflation to the 2% goal. We also got ISM PMI manufacturing index came in at 47.7 today. It was estimated to be 48. Was 47.4 previously. New orders rose to 47 versus an estimation of 42.5. Production fell to 47.3 versus 47, and employment fell to 49.1 versus 50.6. Tomorrow marks the end of a COVID-era food stamp program, which will impact about 32 million people at a time when food prices are very high. The benefit of $251 per month will shrink to $81, which this is a perfect story for our times. Where this sucks all the way around is these people are losing this benefit that doesn't seem like that much money individually. However, collectively, it's a lot of money that impacts and has to come from taxpayers, but it's helping people. But we also need to do it so that we lower inflation, which hurts a lot of people. The Biden administration plan to forgive student loans is not going well in the Supreme Court, so we'll have to see how that comes out. But right after that, they're going to start looking at the CFPB. The yield curve continues to invert. The 10-2 spread is at negative 89 basis points. Last time we saw those levels was during the Volcker tightening regime during the early 1980s. And I'm going to be the only person, it seems like, in the world that is reminding people that the effort to stifle that inflation and the ensuing recession took over 4 years. It was a wonderful 3 months for the UMBS index while it lasted. February performance came in at negative 0.29 in excess return, brought an end to a 3-month long period that was the best in the history of the index. So basically this means that for the last 3 months, people who invested in mortgage-backed securities versus other bonds outperformed, but not in February. From November through January, the index excess return came in at plus 2.3, easily lapping the previous record of plus 1.77 in excess return seen from October through December of 2010. Markets don't move in a straight line, so February is nothing to panic about. Just tip your hat to the great performance streak and we'll move on. Things like that don't happen too often. At the end of the day, ended up being down 27 basis points on the day, with the MBS landing at 99.39. Stocks were down 18, and the Treasury was up 9 basis points. So being at 99.39 puts us well below that bottom line on the 5.5 graph. That has been a pivot point. I'm not going to call it a floor or a ceiling. It's just been a pivot point. It did make a run at it and failed today, and then bounced way lower before rebounding back to where we're at now. Builder Hovnanian Enterprises reported an 8.1% decline in revenues and a drop in gross margins, which indicates that it had to use promotional incentives to move merchandise. The cancellation rate rose to 30%. Hovnanian is exiting Minnesota, North Carolina, Tampa, and Chicago markets. So that's one of those things where it's okay, an 8% decline in revenues. That might explain why they're having bad builder sentiment that Rod always complains about. However, let's put it in perspective. Rocket companies lost $500 million in the fourth quarter, but managed to emphasize that its long-term goals, its recent expense reductions, while also hinting at a new credit card product that could further its lead generation home loans. All in all, in 2022, generated a total revenue net of $5.8 billion, delivered net income of $700 million, generated a total adjusted revenue of $4.6 billion, adjusted net loss of $107 million, or an adjusted loss of 7 cents per diluted share. The company generated $133.1 billion in mortgages, closed loan volume, and the gain on sale was 2.82%. Recall that Rhythm Capital, aka New Res, reported earnings as well. Their mortgage origination fell 43% quarter over quarter, 80% year over year to $7.9 billion. The company is guiding for quarter one volume to fall further to $5 to $7 billion for the quarter. On the plus side, gain on sale rose 10 basis points quarter over quarter, which is 16 basis points year over year. Oh wow, they had a gain year over year. Good job, guys, at 1.8%, which is still a point below Rocket, so it's very interesting there to see how that works out. Funds available for distribution came in at 33 cents per share, so the 25-cent dividend is well covered, at least for now.